What are currency devaluation and revaluation in fixed exchange rates? Imagine a country wants to change how much its money is worth compared to other countries. In a system where the exchange rate is fixed, the government or central bank controls this value tightly. They do this by buying or selling their own currency or foreign currencies to keep the rate steady. Now, sometimes they decide to change this fixed rate. That's where devaluation and revaluation come into play. Currency revaluation is when the government makes its currency stronger compared to the currency it is pegged to. This is usually done when the economy is doing well, inflation is low, or the country has a surplus in its international payments. When they revalue the currency, imports become cheaper for consumers because the currency can buy more foreign goods. This can help reduce inflation and increase the buying power of people. But there is a flip side. When the currency gets stronger, exports become more expensive for other countries. This might make foreign buyers less interested, which could slow down exports and hurt the country's economic growth in the short term. On the other hand, currency devaluation is when the government intentionally makes its currency weaker compared to the currency it is pegged to. Countries often do this when they face economic problems like a trade deficit, high unemployment, or not enough foreign currency reserves. When they devalue, their exports become cheaper and more attractive to foreign buyers. This can boost exports and help reduce the trade deficit. But it also makes imports more expensive, which can lead to higher inflation because imported goods cost more. Sometimes, investors might lose confidence and pull their money out, leading to capital outflows. In both cases, the central bank plays a key role. To revalue, it sells foreign reserves and buys its own currency to increase its value. To devalue, it does the opposite, buys foreign currency and sells its own to lower its value. These actions impact the overall economy. Revaluation tends to slow down demand, lower inflation, and might increase unemployment temporarily. Devaluation usually boosts demand, helps exports, but can cause inflation and short-term economic instability. So, in a fixed exchange rate system, currency devaluation and revaluation are tools used to manage economic health, trade, and inflation. Each has its own effects and risks, but both are important ways governments try to keep their economies balanced.